Welcome to PhillipCapital's Weekly Market Watch. For several months, we've seen a weaker dollar along with higher equities and commodity prices. However, the downward trend in the dollar seems to have reversed. How will this affect stocks and gold? We have with us Ms. Hilary Ho from Phillip Securities Unit Trust Department to talk about it. So Hilary, what is the relationship between the dollar, equities and commodities?
Okay, with the Fed rate near zero, borrowing cost has become almost negligible. At the same time, this meant that the return from holding on to the dollar is actually insignificant. As such, investors searched for higher yielding assets, and equity is one such example. In turn, this will weaken the demand for dollar and cause the value of the dollar to actually shift lower. And a cheaper dollar actually has caused commodity prices to rise as well, as investors hunt for assets with greater store of value. Therefore, with a falling dollar, which declined as much as 15% since March this year, equities as represented by the MSCI World Index climbed as much as 68% as of last Wednesday. Commodities, on the other hand, gained 27%, while gold gained momentum only in the last couple of months, reaching a record high of $1,215 an ounce in the last couple of weeks.
The dollar has shown some strength recently. Do you think such a trend will persist in the near term?
Okay, recent charts have shown that the dollar has broken out of its immediate resistance level. This signals the possibility of a short-term counter-trend rally in the dollar. Other than the technical factors, fundamental reasons are also supporting the possibility of a resurgence in the dollar. Okay, firstly, the possibility of an earlier rate hike as economic conditions improved. In fact, in the latest Fed meeting, the Federal Reserve reminded investors that it would start to wean the economy from an array of emergency supports next year. Okay, that signals that interest rates will eventually be raised and not remain low forever. Okay, secondly, the potential for moves by other countries to weaken their currencies as a stronger currency has hurt exports. Okay, and thirdly, over 90% of US dollar futures traders are bearish. This is a strong indication for contrarian investors. Okay, on a side note, in an interview featuring Mr. Jim Roger, he has also commented buying to more dollars. So, however, having said that, although we think that there is a short-term counter-trend rally in the dollar, the long-term secular decline in the dollar is still in place.
How will a rising greenback affect stocks?
Just like how a declining dollar has lent support to equities, the reverse will take place. A rising greenback will force many traders to close their dollar short positions, and to be able to close their dollar short positions, investors will need to close their long stock positions. In turn, this will cause equities to move lower. Okay, this effect will be more prominent in emerging markets, as statistics have shown that there has been a massive inflow of foreign investments into this region.
What about gold?
Historically, dollar and gold have exhibited negative correlationship. This negative relationship has been especially prominent this year. As such, with a rising dollar, could actually hurt gold prices. However, there could be some buffer for the downside, as sentiments are still bullish, and many believe that gold is in a secular bull run.
Thank you, Hilary. That's all we have for you today. Tune in next week for more market updates.